Chapter 7, Internal Control and Cash. Learning Objectives. 1. Define, explain the purpose, and identify the principles of internal control. 2. Define cash and explain how it is reported. 3. Apply internal control to cash. 4. Explain and record petty cash fund transactions. 5. Explain and identify banking activities and the control features they provide. 6. Prepare a bank reconciliation and journalize any resulting adjustments. 7. Calculate the quick ratio and explain its use as an indicator of a company's liquidity. Vignette video. Lori Joyce is one part of the duo that built the successful bakery cupcakes. After being raised by her hardworking parents on an organic farm in Victoria, BC, she learned the importance of feeding her two boys good quality foods. To fill a gap, she has created new company, Better With Foods, with a focus on delivering high quality, clean, and simple ice cream. Cash management has been critical in managing her new startup. Internal control system. All policies and procedures used to protect assets, ensure reliable accounting, promote efficient operations, and encourage adherence to company policies. Principles of internal control. 1. Establish a separation of duties. 2. Ensure transactions and activities are authorized. 3. Maintain records. 4. Ensure assets and bond key employees. Principle of internal controls. 6. Apply technological controls. 7. Perform internal and external audits. Internal controls will vary based on the nature and size of the organization. 3 drivers of fraud, the fraud triangle: opportunity, rationale, and motivation. Fraud prevention methods: reduce processing errors using technology. 2. Testing system electronic controls. 3. Limited evidence of processing documents and more focus on design and operation of information systems. 4. Increased e-commerce. Limitations of internal controls. Human error includes negligence, misjudgment, fatigue, and confusion. Human fraud: intent to defeat internal controls for personal gain. Cost versus benefits: the cost of internal control must not exceed their benefits. Cash is an important asset for every company. Control of cash on hand and access to it is critical. Cash includes currency, coins, deposits in bank accounts, other items acceptable for deposit. Liquidity refers to how easily an asset can be converted into another asset or used in paying for services or obligations. Cash and cash equivalents are called liquid assets. Companies must maintain a certain level of liquid assets to pay their bills on time. Internal control for cash. Guidelines. 1. Separate handling of cash from record keeping of cash. 2. Deposit cash receipts daily. 3. Make cash disbursements by check. Control of cash receipts. Internal control over cash receipts ensures that all cash received is properly recorded and deposited. These controls include the use of cash registers for over-the-counter cash sales, control of mailed-in cash receipts, the separation of record-keeping and custody of cash. Control of cash disbursements. All expenditures should be made by check. The only exception is for small payments from petty cash. Separate authorization, check signing, and record-keeping duties. Apply a voucher system. 3-way match: approved purchase order, receiving report, and invoice. Mini quiz: An internal control system is all policies and procedures managers use to A. Protect assets, B. Ensure reliable accounting, C. Promote efficient operations, D. Urge adherence to company policies, E. All of the above. The answer is E. All of the above. Petty cash system of internal control. Good internal control procedures require cash disbursements be made by check. The exception, small payments required in most companies for items such as postage, courier fees, repairs, and supplies. Operating a petty cash fund. You have the cashier's office, prepares a check to establish petty cash fund, and the petty cashier. Journal entry. May 1st, debit, petty cash, 75, credit cash, 75, to establish a petty cash fund. Operating a petty cash fund. The petty cashier makes payments from this fund for small disbursements and ensures a petty cash receipt is signed by the person receiving the money to easily identify the expenses paid from petty cash. For example, Exhibit 7.2. Operating a petty cash fund. A check is issued and the fund is replenished when the amount of cash on hand becomes low. There is only $2.20 remaining in the $75 petty cash fund when it was replenished. A cash over and short account is used if needed. Operating a petty cash fund. To replenish petty cash, cash required to replenish petty cash equals the fund size minus the cash remaining. To calculate the cash over or short, you take your total of petty cash receipts minus the cash required to replenish petty cash. Banking activities as controls. Basic bank services are bank accounts, bank deposits and checks, electronic funds transfer, credit card transactions, debit card transactions, Interac, Flash Tap, and Pay technologies. Credit card transactions. Many companies allow customers to use credit cards for their purchases. The risk of bad debts is transferred to the credit card company. The company collects cash from the sale quickly. The credit card companies charge a fee to the vendor. Illustration, credit card transaction. TechCom has $100 of credit card sales with a 4% fee and cash is received immediately. Assumed cost of sales is $40. Debit cash, $96. Debit credit card expense, $4. Credit sales, $100. Debit cost of goods sold, $40. Credit merchandise inventory, $40. Debit card transactions. Many companies allow customers to use debit cards for their purchases. The bank transfers funds from the customer's account to the vendor's bank account. The bank charges a fee to the vendor. The entries are identical to a credit card sale. A customer purchases a $100 of service on October 1st and pays using a debit card with a 0.04 fee per transaction. The entry required by the company is debit cash, $99.60, debit card expense, 4 cents, credit service revenue, $100. Interac Flash. Debit cards that allow customer to pay using contactless debit technology. Merchants can service customers more efficiently. Enhance security against issues like skimming and counterfeiting. The bank charges a fee to the vendor. Bank reconciliations. Bank reconciliations are prepared periodically to explain the difference between cash reported on the bank statement and the cash balance on companies' books. It's an important element of internal control. The bank statement provides information about everything that has gone through the bank account for a given period of time. The general ledger, cash receipts, and cash disbursements journals provide information about everything that has gone through our accounting records for a given period of time. Bank reconciliation example. For example, the bank statement has an ending balance of 2050, and the general ledger cash account has an ending balance of 1404.58. Why are they different? Some items are reflected on the bank statement but not in the accounting records, and vice versa. Reconciling items, bank statement, outstanding checks, deposits in transit, and bank errors. General ledger, non-sufficient fund checks, bank service charges, interest earned on bank accounts, collections made by the bank, and book errors. Let's prepare the bank reconciliation for MovieFlix Company at the end of October 31st, 2020. On the left, we have the bank statement, and on the right, we have the cash receipts journal and the cash disbursements journal. These items appear on both the cash receipts journal and the bank statement. Therefore, none of these items is a reconciling item. So you can just cross them off. These items appear on both the cash disbursements journal and the bank statement. Therefore, none of these items is a reconciling item, so you can cross those ones off. These items appear only in the cash receipts journal or the cash disbursements journal or the bank statement. Therefore, each of these items is a reconciling item. The items that show up only on the bank statement are reconciling items on the book side of the bank reconciliation. So there's the $485 and the $842, and the $30 and the $23. The items that show up only on the cash receipts or cash disbursements journal are reconciling items on the bank side of the bank reconciliation. So that's a deposit in transit that probably hasn't cleared the bank until the following month. And these are checks that you've written, but the person who you wrote the check to hasn't cashed them yet. The final product. On the left, we have the adjusted bank balance, and on the right, we have the adjusted book balance. And notice how now they're both the same. Recording adjusting entries from the bank reconciliation. Here's an example of recording entries on this example that we're using. So we debit cash, debit collection expense, and credit notes receivable. We debit cash and credit interest income. So we're recording everything that was on the bank statement that we didn't put through our books. We debit accounts receivable and credit cash. We debit office supplies expense and credit cash. Recording adjusting entries from bank reconciliation. After posting the reconciling entries, the cash account looks like this. It's now the adjusted balance on October 31st, which is on our bank reconciliation working paper. Review. Discuss the purpose of a bank reconciliation. A bank reconciliation is a procedure designed to explain the differences between the balance in a firm's bank account and the balance on the period's bank statement. The reconciliation procedure examines the differences based on the information available to each party and adjusts for the differences. It also serves as a format for the discovery and correction of recording errors. Identify the principles of internal control. Principles of internal control include the following: establishing responsibilities, maintaining adequate records, ensuring assets and bonding key employees, separating record keeping from custody of assets, dividing responsibilities for related transactions, applying technological controls, and performing regular independent reviews. Using the information, quick ratio, a measure of a company's liquidity, similar to current ratio but excludes less liquid assets. Ratio will vary from industry to industry. Note, it's also called the acid test ratio. The quick ratio equals quick assets divided by current liabilities. Quick assets are assets that can be readily converted to cash and include cash, short-term investments, and receivables. Summary. Define, explain the purpose, and identify the principles of internal control. 2. Define cash and explain how it is reported. 3. Apply internal control to cash. 4. Explain and record petty cash fund transactions. 5. Explain and identify banking activities and the control features they provide. 6. Prepare a bank reconciliation and journalize any resulting adjustments. 7. Calculate the quick ratio and explain its use as an indicator of a company's liquidity. End of chapter.